Welcome back to Finance Dissected, the channel where we break down complex financial topics into bite-sized pieces. Today we're going to tackle the question that many homeowners often face. What's the difference between a home equity line of credit and a home equity loan? Let's dive right in and dissect these two popular options. Before we can understand the differences between a HELOC and an equity loan, let's first establish what they have in common. Both HELOCs and equity loans are forms of borrowing that leverage the equity in your home. Equity is the difference between your home's market value and the amount you owe on your mortgage. For example, let's say your home is currently valued at $500,000 and you have an outstanding mortgage balance of $200,000. In this case, your home equity would be $300,000, which is 60% of your home value. Now let's start with the home equity line of credit, commonly referred to as a HELOC. A HELOC is a revolving line of credit that allows you to borrow against the equity in your home. It's similar to a credit card where you have a limit and you can borrow and repay as needed. With a HELOC, you're typically given a draw period, which is usually around 5 to 10 years. During this draw period, you have the flexibility to borrow money up to your approved limit and only pay interest on the amount you have borrowed. Continuing with our example, if you decide to take out a HELOC for 20% of your home's value, which would be $100,000, you would have access to the full $100,000 during the draw period, but you would only pay interest on the amount you borrow. So let's say you borrow $50,000 from your HELOC initially. During the draw period, you would only need to pay interest on that $50,000. However, keep in mind that once the draw period ends, you enter the repayment period where you can no longer borrow and must start repaying both the principal and the interest. Now let's turn our attention to the home equity loan, sometimes referred to as a second mortgage. Unlike a HELOC, a home equity loan provides you with a lump sum of money upfront. You receive the full loan amount at once and repay it over a fixed term, typically ranging from 5 to 30 years. Continuing with our example, if you decide to take a home equity loan for 20% of your home's value, which is $100,000, you would receive the entire $100,000 upfront. You would then make fixed monthly payments over the agreed upon term, which could be, for instance, 15 years. One of the key differences between a HELOC and a home equity loan lies in their interest rates and payment structures. With a HELOC, the interest rates are typically variable, meaning they can fluctuate over time based on market conditions. This means that your monthly payments may vary if the interest rate changes. On the other hand, with a home equity loan, you would typically have a fixed interest rate for the entire loan term. This provides the advantage of predictability, as your monthly payments will remain the same throughout the repayment period. To summarize, a HELOC and a home equity loan are both ways to tap into your home's equity, but they have key differences. A HELOC offers flexibility with a revolving line of credit and has variable interest rates, while a home equity loan provides you with a lump sum amount, fixed interest rates, and predictable payments. Ultimately, the choice between the two depends on your financial goals, needs, and personal preferences. I hope this video has shed some light on the key differences between a HELOC and a home equity loan. If you have any questions or suggestions for future videos, please leave them in the comments below. Don't forget to like this video and subscribe to our channel for more Finance Dissected content. Until next time, stay financially savvy.